I introduce you to GoviEx Uranium. At least Paul has already done most of the market pitch for me, so I can cut that down to 2 slides. We're a very different story insofar as that we're only in Africa. We are a totally African-focused exploration development story. We have one of the largest uranium resources of any of the listed companies, including the producers. We're about number 4. We have been focused on this company since 2007. We have projects in Niger, in Mali, and in Zambia. The key to us, and very different from the majority of our peers, is that we have 2 fully permitted projects ready for construction. The reason we haven't started, we're waiting for the market to turn, but we're already working on the debt structuring, particularly on our primary asset. We're working on reducing our costs. They're already pretty healthy at $25 cash cost. All-in costs for both projects are under $37 a pound. We got a pretty interesting group of investors with us, with Cameco, Denison Mines, Toshiba Corporation, and Ivanhoe Industries. So a pretty good peer group there. We have over 200 million pounds of uranium on our 3 major projects. About half of it's in Niger. We stopped our drills in Niger at the beginning of 2013. We drilled about 10% of the property that we've got up there. We went over 110 million pounds, of which 100 is in M&I. We really felt at that point there was no point in making it any bigger, but we are actually on the same structure that Areva is on. We could just continue to expand on that. Areva, out of interest, have been operating since 1971 on a piece of ground the same size that one of our 5 licenses is. So a lot of exploration upside. As I say, from a peer group point of view, substantial resource in comparison. We are one of the few companies also that has got multiple projects within the portfolio. Most companies only have a single project. I have to put something on the market. Really, I think that what you're looking at here, and just put it into nuts and bolts, you are looking between 2 and 4% growth globally across the market forecast going forward. Paul made a very interesting comment there. I mean, Germany as well, someone did an analysis on German energy. They have to increase grid capacity by 40% if they want to have EV cars on the forecast they've got. Currently, they're struggling to even meet capacity. So you've got this strong growth. At the same time, you've got decline in production going forward. 20% of production, even from now, is about to close up simply because it's run out of anything to dig. Companies, projects like Ranger, like Rossing, even Cigar Lake has only a 20-year mine life and shuts down. At the same time, you've got an industry where 75% of the industry operating today, either on a cash or an all-in cost, is actually underwater and is making no money at all. Hence Cameco's decision to close up its McArthur River, simply because it can buy it cheaper in the market than it can produce it itself. There is no point. The other point is this uncovered position. Last year we were suffering with inventory issues. We were suffering with oversupply. The oversupply issues certainly with the reduced cuts coming through. We've even seen cuts on the conversion side of the industry with Convidine shutting down its UF6. We're starting to see cuts on the enrichment side as well coming through the whole project side. But the issue going forward is going to be the requirement that the utilities need. They hold generally between 2 and 3 years. A lot of them are starting to see those contracts come off fairly quickly and are going to be buying. And we're getting the same feedback from the big utilities we're talking to. So GoviEx strategy is all about putting in their projects into production. Madawaila will go into production first. It's already permitted. Matanga in Zambia will then follow it 2 or 3 years later, partly because trying to start 2 projects at the same time is hard enough for any management. Doing 1 is tough. Madawaila in Niger, it's currently a 21-year mine life. It's right next to Areva's projects that are operating since 1971, producing 8% of the world uranium in Arlet and Niger. All the infrastructure is there, power's there, roads are there, people are there. The Niger government is very supportive. There's about 60% of Niger's exports are uranium. The 2 mines next door produce 8% of world supply, are due to go out of production in the next 5 to 10 years. The Niger government needs somewhere to employ those workers going forward. In Zambia, it's in the southern part of Zambia up against Lake Kariba, currently a 10-year mine life. This is a very simple project, $120 million capital to get this project up and running to produce about 2.5 million pounds a year. Infrastructure is all there, power, people, roads, water. Again, fully permitted, both of these projects. We need nothing to get them going. Both of these have considerable exploration upside. We have 140 kilometers of strike here. We have a 40-kilometer gap between our 5 main deposits. We've got trenches in there that show there's another several deposits. We've just never drilled them. What we're doing at Madaouela, one of the questions that was always raised early on is, you're in Niger, how will you ever fund it? Well, we've now got expressions of interest from 5 commercial banks and 2 ECAs, indicating they will provide us a 2/3 debt coverage on this project, subject to the completion of the DFS and the offtake. We've already started the conversations on the offtake side. We're looking for a collar structure in there. I'm still working on optimizing this project. I believe I can get big cuts out of both the CapEx and the OpEx. So towards the end of this year, we'll be expecting to finish off our DFS, subject to the uranium market, make a decision to pull the trigger on the debt and the offtake side. The equity, obviously, once you've sorted that out, becomes a lot easier to do. We've got a management that's been in the industry far longer than it can remember. A lot of it's been in the uranium. I've been in multiple commodities. I've actually worked in Russia. I've worked in Canada. I've worked in South America. And I've also been an equity analyst for my sins. We have a board as well. My chairman, Govard Freeland's at the back, son of Robert Freeland. David Cates is the CEO of Denison Mines and of UPC. Benoit Lassalle is the founder of Semifo, one of West Africa's most prolific gold miners. Strong structure. Last year we doubled our share price and the uranium price went down, so we've been doing the right things. I said, strong shareholder base, they're all very supportive of where we go forward. We're highly liquid as well. I've done a lot of work on liquidity. We trade about 1% of our free float every day. But despite all of those positives, despite the team, despite the large resource, despite the fact I have 2 permitted projects and not a single company on here has a permitted project, with the exception of Berkeley there, we're trading a massive discount. This is exactly what happened to Paladin Resources in the last cycle. Paladin was one of the only 2 companies to actually build a mine in the last cycle. They went from 7 cents to $7.50 over 2 years. That is the potential. The other thing people always say to me is, but you're in Africa, it's difficult. And I say the 3 largest transactions were actually completed in Africa in the last cycle. Makuja River, Trekopi, and Husab were all bought out between $1 and $2.5 billion, and they're actually all smaller than us. So that is the potential that Africa has. Why? Because projects can get built. The big guys who are looking for the big projects want to be able to run them, not just own a project that they're going to be permitting in North America, for example. So very simple strategy, strong shareholder base, enormous resource, 2 fully developed projects ready to go. We're already working on the debt financing. We've got a lot of upside on these projects as well. Thank you very much.